Let me welcome all of you today to our Peterson Institute for International Economics. This is the second in our relatively new series on what we call the $1 Trillion Club. The $1 Trillion Club is the group of 6 emerging market economies whose GDPs exceed $1 trillion. I should say, which still exceed $1 trillion in purchasing power parity dollars. In market exchange rate conversions, a couple of them have defected below the magic number. We think that's temporary. We hope and believe it is. We keep them in the club, at least for the moment. But they have sort of declined, so those of you who are sticklers for precision will have to accept that asterisk on our membership for the group. But the reason we do it is the obvious one. The emerging markets as a group have now become fully 1/2 of the world economy. Again, with exchange rates and purchasing power parity, about 40% at market rates. These 6 countries that make up the $1 Trillion Club are in turn half of the emerging markets group. So they account for about 1/4 of the world economy. And of course, given relative growth rates, where this group is growing, and even more so the differential now in the crisis, their share of the world economy is continuing to grow very rapidly. So a decade from now, it'll be 60%, maybe getting close to 2/3. And as you look out to 2025 or 2030, as Goldman Sachs frequently does in its analyses of the BRICs, you find that the $6 Trillion Club members would be 6 of the top 13 economies in the entire world, along with the G7, as the dominant economies in the entire world. So they're obviously a key component, a key element in the entire global economic picture, and their growth has made them world leaders in the boom period prior to the crisis. And the issue for today, really, that we want to discuss is both how the crisis has affected them and how their future performance may help deal with the global need to pull out of the crisis that we are now so deeply into. Today we have 3 parts to our program. The first part, presented by our senior fellow Arvind Subramaniam, will look at the relative performance not just of the $1 Trillion Club countries, but all of the G20 countries, to kind of assess the relative hit that individual countries have taken from the crisis. Who's been most affected, who's been less affected, and to some extent why. What are the reasons why we get big differential impacts across the G20 countries, again, with the 6 members of the $1 Trillion Club at the heart of that. Then we're going to turn to senior fellow Nick Lardy on China, not only the biggest of the emerging markets, but now having just passed Germany, even at market exchange rates, to be the 3rd largest economy in the world, probably past Japan in another couple of years, maybe even next year, to be number 2 in absolute economic terms. Steve Roy was just saying that my G2 concept is now becoming widely adopted. And as one looks at the G20 summit coming up in a couple of weeks, the 2 countries that have the big fiscal stimulus packages, as well as the 2 virtually biggest economies, are the United States and China. And on their shoulders will fall a lot of the global recovery. Nick will talk about how the crisis has affected China, and in turn, how its outlook may affect the world as a whole. Then we want to turn in our 3rd segment today to Mexico, closer at home, sometimes neglected in the debate. To what extent has the U.S. turndown spilled over into Mexico? What is the outlook there? How are they responding? And what is the prospect for their recovering from the crisis? And in turn, because of their significant effect on the U.S. economy, what might it do for us? So that'll be the focus of our presentations today. Then, when we conclude with the initial remarks and turn to discussion with the audience, the speakers from today will be joined by Marcus Nolan, our expert on Korea, by John Williamson, our expert on Brazil, so that we will be prepared, and of course Arvind Subramaniam is our expert on India, as well as giving a broader presentation. So we'll be prepared to discuss 5 of the 6 members of the $1 trillion club. The one exception is Russia. That's largely because our expert Anders Osland is in Europe, is on the road, but also because he's just finished a new book called The Russia Balance Sheet that we'll be presenting separately here in a meeting next month, and so we'll address Russia at that time. So that's the layout. I'll turn to Arvind to lead it off with an overview of whither the $1 trillion club, then to Nick on China, to Gary Huffbauer and Barbara Kochwar on Mexico, and then to a panel to look at the $1 trillion club as a whole. Arvind.
Thank you, Fred, and thanks to all of you for coming. My job is to provide an overview, but before I do that, my job is to provide an overview to set the stage for my colleagues to provide you with some more in-depth discussion of their countries. So I'm going to talk about briefly about the growth impact of the crisis, what the response has been in these $1 trillion club countries, floating between the $1 trillion club and G20 as Fred suggested, and ending by drawing some kind of tentative conclusions based on what we've seen so far. So I want to start by giving you some measure of the impact of the crisis on the G20 and $1 trillion club countries. So the way I measure impact is to see what the decline in growth rate has been in the crisis years relative to the pre-crisis growth rate. One can do this in different ways. One can say a 1% decline in growth is the same across all countries, and that's a fair point. But you want to scale it so that one gets a sense of what the loss has been relative to some, say, potential or trend that countries were on before the crisis. I'm going to use growth rates from IMF's most recent January projections from the World Economic Outlook, but I'm also going to give you a sense of where our experts see these projections from their own perspective. So let me turn to this table, which summarizes the growth impact on the industrial countries and the $1 trillion club countries. So the first column has the pre-crisis growth rates. The second column is based on the projections, what the average is going to be for the two crisis years, which for the sake of today, let's assume is going to be 08 and 09. And the growth rate for 09 is given as well. And the fourth column is really the metric that I want you to focus on, which is what the decline in growth rate is as a percentage of the pre-crisis growth rate. But before I get there, as I said, I want you to focus on the 2009 growth rates for the $1 trillion club countries, just to tell you where my colleagues think they agree or kind of mildly disagree with these estimates. I think for Brazil and India, the IMF estimates seem to be broadly reasonable. Nick will tell you later that the estimate for China is perhaps, the IMF's projection is a bit on the low side, and he expects something between 7 to 8, because especially if one factors into account the fiscal stimulus that China has enacted. Marcus thinks that South Korea the estimate is on the pessimistic side relative to what the consensus is. And Mexico and Russia, Gary, Barbara, and Anders, who I was in email touch with, tend to think that the IMF forecasts are a bit on the optimistic side, and they expect something a little bit more dire than what these numbers suggest. So having said that, two things to notice about this is that first, $1 trillion club countries are on average affected less than the industrial countries on this metric. So they're all at the bottom end. So the countries are arranged by declining order of being affected. Italy has been the most affected, and the $1 trillion club countries least affected. And second, within that, there are two categories. India, China, and Brazil are, even amongst the $1 trillion club countries, less affected than South Korea, Mexico, and Russia. And then, so one might ask, can we explain why this differential between these $1 trillion club countries? So I just did some very simple, not at all scientific or rigorous, but just related, my metric of the proportionate decline in growth rates against the exports of goods and services, and it seems to be that there is something going on here. So the more exposed you are to exports, what you would find is that the greater the decline in growth rate. I want to make 3 remarks on this chart. Saudi Arabia seems to be an outlier on this, and I'll show you the next chart where it is. And China too seems to be an outlier because it seems not to do too badly given that it's highly exposed to exports. But the growth measure, you must remember, is after factoring into account the fiscal stimulus that China is planning to enact. So if in fact you had decontaminated the endogenous policy response, you would have seen China behaving much more typically relative to this relationship that I've just plotted. Final remark is that, to me, a very vivid illustration of this actually comes from India, where things are relatively less bad compared to the other countries. And it turns out, of course, that in India, agriculture still accounts for about 20% of GDP. And agriculture has not done too badly because, the gods have been kind in terms of the weather and the monsoon, but also because, agriculture has been less immune to the shocks emanating from the rest of the world. And as a result, in India, politicians who routinely get thrown out because of what we call an anti-incumbency phenomenon, in this case, it turns out that the current government, which is facing elections in about a month's time, is actually seems to be relatively better off compared to what you would expect the crisis would do to its electoral prospects, because agriculture, on which 50 to 60% of the economy still lives off directly or indirectly, hasn't been doing too badly. The rural sector is not doing too badly. The global financial crisis, partly because of being less open to exports, it seems that the impact is going to be less. So this is just to be completely transparent. The relationship Saudi Arabia is an outlier on this relationship. So how have countries responded? On the monetary policy side, you find two types of responses, 2 distinct types of responses. The Asian response, one can say, has been aggressive monetary policy response. As you can see, from about the fall of last year, the Bank of Korea has cut its policy rate very aggressively, and this has been absolutely typical of all of Asia. India, Thailand, Singapore, Taiwan have all, and of course not to forget China, have all relaxed monetary policy very aggressively. The second type of response, captured in Brazil's response, it's been much more cautious. In fact, interest rates went up when the currency came under pressure in the summer and fall of last year. But since then, there's not been very much monetary policy easing. This has also been true of Mexico, and of course Russia is under pressure, so interest rates remain high in Russia as well. What about the fiscal policy response? Actually, again, you can see 2 categories of countries. Brazil, India, and Mexico have been relatively cautious in employing fiscal stimulus, whereas China, Russia, South Korea, and China, especially China, has a pretty big stimulus package, which Nick kind of estimates at about 2% of GDP, both for 09, 010, maybe slightly higher. But China is very much amongst those which has been loosening fiscal policy. Now, a short detour because yesterday's New York Times article, front page article, provokes this. So the New York Times article yesterday, the front page article said that there's a kind of third wave of the crisis, which is captured by the fact that financing is drying up and that it's becoming a serious problem. Now, so the question is this financing a binding constraint? And I would argue that the piece yesterday was kind of overgeneralizing and painting with too broad a brush. It's certainly the case that the external finance has dried up, and it's also the case that parts of the world, emerging Europe and in Latin America, still face this, as evidenced in the fact that interest rates remain high. And as I showed you, there haven't been significant declines in market or policy interest rates. But where I think the article goes too far is in relation to Asia, because it seems to be the case in Asia that what is happening is that it's the trade channel that's proving to be the real problem rather than the financing channel. Collapsing world demand and exports seem to be the real problem and not finance. Of course, it's always very hard to distinguish the two, but prima facie, what is my case for saying this? If you really had a shrinking up of finance and the supply of finance was shrinking, you would expect, ceteris paribus, a sharp increases in the price of money and interest rates. But in fact, as I showed you in Asia, exactly the opposite is happening. Policy and short-term interest rates have declined substantially in some cases. A related point, one hears a lot about, trade financing drying up and becoming a problem. Of course, if trade is collapsing, it's not difficult to believe that the demand for trade financing is also collapsing. So whether trade financing is the constraint or whether it's derivative of an underlying phenomenon of the collapse of trade and demand seems to be a question worth pondering over. Finally, what are the lessons, or kind of the tentative lessons that one can take away based on what we've seen so far? One, I think it's fair to say, certainly from the chart that I showed you on exports and the growth impact, that there can be such a thing as too much of a good thing. Mercantilism and especially mercantilism on steroids, as Fred sometimes likes to put it, can have costs, which is that when demand collapses, you are much more vulnerable to that downturn to external circumstances. A kind of related lesson that I draw is that, of course, small open economies are especially vulnerable because the shocks really do become, if you're very open to trade, the shocks do become very big relative to the ability of counter-cyclical policy to attenuate the impact of the shock. The flip side, of course, is that larger economies are more able to counteract external shocks through policy. But then I think this requires two kind of prerequisites or fundamentals to be, in fact, able to deploy such a counter-cyclical policy. And I would draw your attention to two facts again. One is that I think it has been the case that Asia has been able to use monetary policy much more aggressively without fear of losing investor confidence, especially of residents, because it went into this crisis with much stronger fundamentals. Corporates were healthier, fiscal positions were stronger, external positions, current account deficits were smaller, and reserves were much larger, were substantial, and which helped Asia cushion this. So there is a key difference between Asia today and Asia in the 1990s, and there is also a key difference between Asia today and emerging Europe today, where the fundamentals in, say, Ukraine, Latvia, Hungary, Romania are much more shaky. So one shouldn't paint with too broad a brush. I just want to something that we've almost forgotten, that in the Asian financial crisis, one of the big dilemmas was whether or not to raise interest rates, because raising interest rates had this tension. On the one hand, you had to do this to maintain confidence, but on the other hand, it was having an adverse impact on corporates and the financial sector. But in this crisis, that's almost been a non-issue, and almost all Asian countries have been slashing interest rates quite substantially. Last point, I think, which really stands out from this crisis is that, part of these strong fundamentals, I think, does involve improving the public sector balance sheet in good times so that one can draw upon that asset, as it were, in bad times. And to me, the best contrast here is between China, which has a public debt, as Nick will tell you, about less than 20% of GDP, which has been able to ramp up the fiscal stimulus quite substantially, like the US as well. And the contrast is with India, which is unable to do so because its public debt is 80% of GDP, and it's hamstrung by not having strengthened the balance sheet during the good times. A last point I think I need to make, especially with Carla sitting here, is that I haven't spoken about the protectionist response to the crisis. I think it's fair to say that at least 17 of the 20 G20 countries have taken measures that violate certainly the spirit, if not the letter of the communique that they issued last November, not to impose trade restrictions. At this stage, they seem to be in terms of magnitude, not very serious. So, I mean, we're still in a phase of what I would call low-grade protectionism, but I think we need to be very watchful because there is a kind of non-finite probability that this could escalate into something more serious, and I think we need to be watchful of that. Thank you.
I have to start out by saying that if you're Wen Jiabao or you're sitting in Beijing and you've seen the growth rate decline by more than 7 percentage points, you probably don't think you're one of the least affected economies in the world by the global economic slowdown. China has slowed down, certainly in absolute terms, more than anyone else, and since growth is related to job creation, tax revenues, and so forth, I think China does face a very, very substantial challenge, even though by Arvind's metric they may seem to be doing reasonably well. The causes of the slowdown, the first surprising thing is that net exports are still contributing to growth in China in 2008, but a little bit less than they were. You can see in 2005, 6, and 7, look at the pink line, a very substantial increase in net exports in those years. The external sector contributed about 2 to 2.5 percentage points of GDP growth. Last year we were down to about 0.8% of GDP growth coming from the external sector. But the contribution of the external sector, at least as of 2008, had slowed down but had not gone to zero. So obviously there's another factor we have to consider, and that really is the property sector. China has been having a property correction, modest so far, but nonetheless contributing to the slowdown in domestic economic growth. You can see prices are no longer rising rapidly. Indeed, the rate of increase is slowing down. In the last few months, we're in negative territory. Prices are falling in absolute terms. That has led that's accompanied by, or caused by, or coincides with, or correlates with a substantial slowdown in sales of property. You can see that throughout this year, throughout 2008 and also continuing into this year, there's a fairly sharp decline in sales. Obviously, inventories are growing. For the year as a whole, they grew by about 20%. And the growth of floor space under construction, there's a lot of month-to-month variation here, but you can see the last year or so, a little more than a year, there's a fairly noted slowdown in construction as measured by the growth of new starts, basically. So China's slowdown has two sources, really. It's the external, where they've lost maybe a 1.5% of growth, and the internal from the slowdown in the property sector. Now I want to turn next to looking at the policy response, and I have said, and I will say again today, that I do think China's policy response is the gold standard. No one is doing more to counteract the downturn than the Chinese. And it starts with the monetary side. Arvind's already given you this in broad brush terms. China started monetary easing in September. They got rid of the lending quotas. They started reducing benchmark lending rates. They've had 5 interest rate cuts since September. They've cut the reserve requirement 4 times over the same period so that banks have more liquidity. And you can see by the last couple of months of the year, lending growth picked up quite a bit. The January number is extremely high. The early indications are that the February number will be in the 900 billion to 1 trillion RMB in additional lending. So China's monetary easing is working. This is very different from the story in the United States and many other OECD countries where injections of money into the financial system have not led to significant increases in credit, primarily because of the collapse of non-bank financial institutions. So China's getting traction, I think significant traction, from its monetary policy, and it was early, as I said, starting in the fall. The infrastructure is the next component, the investment component. The headline number is 4 trillion. There's still a debate about how much of that is truly incremental, but you can see it's broadly distributed across a number of different functional areas. As Arvind said, I think this probably amounts to about 2% of GDP on a true incremental basis. Then the third thing China's doing that gets much less attention is that they are very dramatically ramping up their social expenditure programs in the areas of health and education in particular, and also they're increasing transfer payments quite dramatically. Their transfer payments to low-income households, which is about 70 million people, have increased substantially in 2009. Pension payments have been increased substantially for those people that are already retired. The increase that took effect in January is several times the rate of inflation last year, and apparently an infinite multiple of the inflation this year, since China's now in deflation. So this I think is highly welcome, because it is part of the rebalancing program that they've had on their agenda for a long time. If they can get the social safety net built out a little bit more, people will begin to spend more and save a little bit less. I'll just focus for a second on health care. This shows the distribution of health care costs and the size of health care costs in '78 when reform began, and in the year 2001, which is kind of the end of the restructuring period when so many state-owned enterprises went out of business or were privatized and so forth. And the key takeaway here is that at the beginning of the reform process, that little yellow sliver that you see in the small circle is the 20% of health care costs that were paid for by individuals on an out-of-pocket basis, and that had ballooned to 60% of health care expenditures by 2001. Now, the government has recently announced a very substantial expansion of the health insurance scheme, or I should say scheme, since they have more than one. But the goal is to bring another 400 million people into the system by 2011, and to increase in this, according to Wen Jiabao's report, as true incremental expenditure, spend an extra 850 billion RMB over the next few years to bring this about. At the end of that process, the share of health care costs that will be paid for by the state, according to the statements emanating from Beijing, will be in excess of 50%. So basically see a tripling of that blue segment, going from about 15% to a little over 50%. Obviously, that means the out-of-pocket health care costs as a share of the total will decline quite substantially over this period, which should contribute to the rebalancing program. So these are the main dimensions of policy response: the monetary easing, the investment program, and the rebalancing components, the increased emphasis on education and health expenditures. If you look at the IMF, I think these may be the same numbers that Arvin had. I don't have absolutely every country on here. These are from the note the IMF did for the G20 deputies meeting. And you can see China is at the top of the list in terms of the size of its fiscal stimulus package. And this, for China, very substantially underestimates the overall program, because this is an estimate that is based on the amount of expenditure that is going to go through the budget, and a very substantial portion of China's stimulus program is going to be going through the bank and financial system in the form of increased credit. So I think if you could make an adjustment, China would be even more of an outlier in terms of the size of the policy response that has occurred so far. What are the implications of this? Well, I think first of all, I would argue that it is quite likely, or at least certainly probable, that China will be the first off the bottom. And it could come as early as this quarter or next quarter. In other words, on a sequential basis, I would expect that either in this quarter or in the second quarter, China's growth rate will be back into positive territory. It's because of the nature of the stimulus program that I've just described, and the fact that the financial system is not exposed to any toxic financial assets. They didn't buy any from abroad, and the regulator didn't allow the creation of any toxic financial assets of what I would call indigenous origin. China also is not vulnerable to the kind of withdrawal of foreign capital that Arvin was laying out as a possible cause for concern for many emerging market countries. This is a diagram that simply points out and reminds us that China is the world's biggest creditor country, a massive creditor, cumulative position probably about $1.5 trillion US by the end of last year. So China has not been financing its growth by borrowing. It's not vulnerable to a slowdown. Yes, foreign direct investment is slowing in the last few months, but foreign direct investment in China, the gross inflows finance only about 3% of China's investment program. So even if they disappear, the short-term effects would be relatively small. Chinese corporates have virtually no debt. There's been no borrowing abroad. We don't have big multinationals as we have in India and Korea and so forth that undertook a lot of foreign currency debt and now have been caught as their currencies depreciate with a very substantial increase in their debt burden. And China also is not subject to foreign banks withdrawing their capital. That's another component of the difficulties some countries are facing. If you look at the Chinese banking system, only 2% of the assets are controlled by foreign banks. In other words, foreign branches and subsidiaries operating in China only account for about 2% of the banking system. Another big structural advantage that China has is that it does not really need to deleverage. This is a diagram showing us household debt relative to GDP in China, the US, and the UK. And the point is fairly obvious. Chinese households don't have much debt. They've been saving a lot. They're not incurring debt. Mortgages to GDP are about 10%. In the US, it's 75%. The average down payment on a mortgage in China these days is about 50%. People don't wait a year or two and rush back and refinance and take out their equity. These kinds of things don't happen in China. So cars, China's now the world's biggest car market. 90% of all cars sold in China are sold for cash. Automobile loans are very, very rare. So when people buy cars, again, they're paying for it in cash. So there's very, very little household debt. So China's very different from the United States, where the savings rate is rising in response to the huge loss of wealth on the equity and the property side. And as a result, we're in negative GDP growth because consumption is 70% of GDP, and when household consumption declines, GDP growth is going to go negative. China doesn't have that kind of financial leverage in the household sector, and so that is not going to be a drag on Chinese growth the way it is in the United States. Also, the financial side, I was going to give you the diagram that shows kind of net debt. Chinese financial system has very, very little debt. It's, I can't remember exactly, 10-15% of GDP. The United States is 80%. You get kind of the same picture from this diagram. Chinese banks, the largest ones, are very well capitalized. Their capital adequacy has been improving in recent years. They have a lot of liquidity. And again, no deleveraging going on in the financial sector either, which is the source of many of the difficulties in getting lending growth resumed in the United States. So the combination of some of these structural factors in terms of the balance sheets of households, financials, the strong fiscal response, the rebalancing efforts, the monetary easing, I think create the possibility of China being one of the first economies off the bottom, and probably in the first half of this year. I would go even a little bit further and say that China also has the possibility of converging back to what I would consider to be its long-term potential growth, which I would put at something on the order of 9 to 10%, of converging back towards its long-term potential growth more rapidly than most other economies. Again, part of it is the deleveraging. Household deleveraging in the United States could go on for several years. I think there's a debate about how high the savings rate of households will go, how long it will take to rebuild household balance sheets, but there's certainly the prospect that we'll have, even after the recovery begins, that we'll have a rather weak consumer sector in the United States for a period of time. China doesn't have that. But more importantly, as you look further out, the factor that Arvind mentioned, I think, is quite important. Chinese public debt is a shade under 20% of GDP. The U.S. is over 50, and as he mentioned, India is 80. So, and the other thing to look at is the fiscal deficit. China's got the world's biggest stimulus package, and their forecast, I think it probably turned out to be low, but their forecast is this year they'll have a fiscal deficit of only 3% of GDP, compared to, say, the 12.5% in the U.S. So what is likely to happen during this period is that even as China's growth slows down a bit, their debt-to-GDP ratio is going to actually decline probably. As Arvind said, I think they can grow at 7 to 8%. Maybe it'll drop to 6%. But with a fiscal deficit of only 3%, obviously their debt-to-GDP ratio is going to be falling. So they're going to come out of this crisis in a very strong position relative to many other states. The debt ratio is going to fall, while certainly in the U.S., as we have double-digit deficits for a couple of years, and very low or negative growth, our debt-to-GDP ratio in a couple more years is going to be up in the 70-75% range, which would be more than 3 times that of China. So China, I don't think, is going to face the problems associated with what economists euphemistically refer to as medium-term fiscal sustainability, which is just a nice way of saying you're going to have to raise taxes or cut expenditures once the crisis is passed, which could have negative effects in terms of converging back towards long-term potential growth. So in summary, I think China's vulnerable to the global slowdown. It's through the trade side, as Arvind said, not through the financial side. The policy response, I think, to date has been the gold standard, and I should say, if things get worse from the Chinese point of view, they have plenty of capability of stepping up their expenditure programs given their strong fiscal position. I think they'll probably be reevaluating that once they have the first quarter GDP numbers and make adjustments if they feel they are necessary. So China has the prospect of being the first off the bottom soonest, and among the earliest to converge back to long-term potential growth, as I said, due to a combination of the policy initiatives and the favorable structural factors reflected in the balance sheets of the households, the financial sector, and the government itself. This is all good news for the global economy. I think China's current account surplus, which I showed you, or I didn't show you the current account, but I showed you net exports of goods and services in one of the early diagrams. I think they are likely to level off or even fall in the current year. And so I believe China will be adding to aggregate demand in the rest of the world for the first time in many years. So I do think it reinforces the theme that Arvind mentioned, the prospect for the United States and China cooperating on encouraging other members of the G20 to take more positive adjustments on the fiscal side in response to the global crisis. Thank you.
Well, this won't be the unalloyed good news that you heard from China. First of all, I have to thank Barbara Coxwar, who did all the heavy lifting on this and will answer all the difficult questions afterwards. This is the first time we've included Mexico in these kind of sessions, and as Fred indicated at the outset, does it really belong? Well, last year's exchange rate, it did belong at $1.1 trillion. This year, there has been a very sharp devaluation of the peso to about 15 pesos to the dollar, and so it would be a little bit below. It would be at 750 billion. Now, I've got a lot of slides here. They will be on the website either later today or tomorrow, so if you're interested, get them anyway. This is at a PPP basis, and Mexico's GDP has been doing quite nicely. And here you get kind of the macro policy, which has been extremely good over quite a few years now. You can sort of see the numbers there. The inflation rate is remarkably low and continues even now below 7%. Considering the sharp devaluation, I'll come to a chart later, but the devaluation is really quite sharp, about 40%. So the pass-through has been of the exchange rate to inflation has been quite modest so far, but the sharp fall in the peso and the concern about investor confidence, highlighted in some of the earlier remarks for other countries, is a very real concern for Mexico. So that does constrain monetary policy and probably also fiscal policy. Debt's quite low. This is very different than the crisis back in the 90s, and official reserves are quite strong. They're about $80 billion now. Again, that's a sharp turnaround from, let's say, earlier times. And again, the Mexican authorities do want to keep this strong reserve position, and that's another constraining factor, but that's a key to investor confidence in Mexico. Now, so that's the good picture. I mean, they really have followed John Williamson's prescriptions to a T for a decade. And on the macro side, I mean, just remarkably disciplined. Now, what about the external side, as the lead slide showed? Difficult external conditions. Well, what does that really mean? That means the U.S. is in the tank, and that unfortunately puts Mexico in the tank too, because all the important indicators are highly correlated with events in the United States. Starting with industrial production, which for obvious reasons on the trade side and the highly integrated markets are going to be closely correlated. But coming more broadly to GDP, at one time one could sort of count on Mexico growing at about 2% faster than the United States. That is no longer the case. Mexico, if anything, this year will decline more than the United States. I think, as Arvin mentioned, the fund projection at minus 0.3% is the most optimistic, and a more realistic one by the authorities in Mexico might be about a negative growth of up to 1.8% or so. And the Economist Intelligence Unit is down to a minus 2.6%. So those numbers are actually worse or as bad as the United States. There's no positive differential for Mexico. And as one might expect, if we have it here on the trade side, you can kind of see these trade numbers. They're dropping like a stone. There are a couple of magnification effects going on here, which I might just briefly mention, not in U.S.-Mexico trade, but globally. First of all, trade is highly concentrated, for the United States at least, and many other countries, in the consumer sector and in a segment of the consumer sector. It's not insurance, it's not education, it's not health. It's consumer durables and many non-durables, which can last a bit longer in tough times. And then you have the other magnification effect, which is certainly between U.S. and Mexico. Goods cross the border multiple times as value added is, the slicing up of the value added chain. But when you unwind that, then trade shrinks more rapidly than expenditure. So this is what's going on, and the numbers are showing it. Now, the Mexican stock market, again, pretty much like the U.S. stock market, down about 40% or so, very closely correlated with the U.S. stock market, has taken a real hit. Foreign direct investment in Mexico is down, but maybe not as sharply as one might have expected given the drug wars, and I'm coming to those later just to wake people up at the end. But, it's down about $10 billion. That's not terrible, but it is lower. And remember that after NAFTA, there was a tremendous boost over a long period of time in foreign direct investment in Mexico, from just a couple $1 billion to this kind of, I would say, normal range of $25 to $30 billion, but now we've had a setback. The remittance level, now this is very interesting story. Again, you see it's kind of flattening off. It's not terrible, but it's not growing. And this is a little bit busy, but do print out the chart if you want, because there's some very interesting phenomenon. Remittances to the northern states are not a big thing, because most of the people in the northern states of Mexico are doing, moderately well by Mexican standards, and they don't have the motivation to migrate to the United States as people in the more middle states, Michoacan, and down there you can see where the arrows are going, and Guanajuato and Jalisco, and that's, of course, where the remittances go back to those parts of Mexico where that's where the dominant flows are, and so, of course, they're taking a hard hit with the small fall in remittances. Now, where do the remittances come from? Well, they come from the obvious places: California, Texas, Arizona, somewhat from my old state of New Mexico. But in any event, those states along the border on the United States side, they have been pretty hard hit. Property values, obviously in California, oil in Texas and so forth, Arizona, again, property values. And those are high unemployment states. So, of course, that has reduced the number Mexicans who are there, and some of them have returned home or maybe migrated elsewhere in the United States. So that's been another source of hit on Mexico. That is the concentration of where immigrants are living. Now, Mexico, despite doing everything that John told them to, it's still paying the emerging market debt premium. You couldn't ask for a better kind of fiscal, monetary, and so forth position. I suppose you could ask, but it really has done quite well. But the spread, nevertheless, is very similar to all other emerging markets, as you see in these difficult times. Shot up like a rocket there, and that's some more pain. And as I said earlier, this devaluation, it's remarkable. A very large devaluation. It's remarkable that the pass-through so far has been so small. It's certainly a concern to the authorities that the floating exchange rate, this is what is delivered. But while there have been a few corporate failures, there's one in the retail sector, and CEMEX was in great difficulty. It was even said that Telmex did some imprudent hedging, that is, thinking that the peso was going to get stronger against the dollar, and so bought some U.S. assets, including less than top quality mortgages, and so they've taken a big hit. But it's not the kind of bad corporate news that Mexico suffered back in the 90s. Though it's not pleasant, but it's not the same degree of pain. And so they've had this huge devaluation without the kind of decimation of the corporate sector, or, as I said, the inflation, but it is a watch point for the authorities. Now we turn to the difficult microeconomic picture, which I think has been very much in the newspapers lately. When Barbara started preparing these slides, things were fairly quiet in the newspapers, but it's gotten up to a lot of attention. Yesterday I was on Fox News, where the link was between NAFTA and the drug wars. NAFTA is responsible for that, just like Katrina and Citigroup and everything else. NAFTA takes a lot of blame these days. But in any event, Mexico has fallen on the Corruption Perceptions Index. And whether it's actually fallen in corruption, kind of who knows, all we have are perceptions, but that's not particularly good. And here in this, comparing this report, it's remarkable. I spent time in Pakistan and spent a little time in Mexico as well, more in Mexico than Pakistan, but to fall behind Pakistan. Now this is before these recent troubles in Pakistan, I must say, but still, even if we go back a year or 2 years, the Mexican position wouldn't seem to be behind Pakistan's, but there it is, at least in perception of many people. Then we have the Doing Business report that's falling, and then in the FDI confidence index. But I guess there the thing is surprising how high the confidence has remained given the difficulties. Now this is there's the one everybody's been reading about. And Barbara put this together quite nicely. This goes for about 2 years of drug deaths. And you can see where they're concentrated, the size of the circle. You can't probably read the numbers, but that indicates where they are concentrated. So there are a lot of deaths on the northern border. And of course, most of them are drug folk killing other drug folk, but as everyone in this room knows, the drug cartels have a spin-off business, or a couple of spin-off businesses, one of which is kidnapping, mainly Mexicans, but a few foreigners, and the other is shakedowns, and that really hits Mexican medium-sized and small business pretty hard. It doesn't probably hit multinationals very hard, but it is a serious spin-off business and could, maybe fairly entrenched. So you get a lot of deaths there on the northern border, and these, of course, are the areas of Mexico which have the greatest geographic and linkage advantages with the United States, but this is quite a negative cloud. The finance ministry has said that they attribute a 1% loss of growth, and how they do it I don't know, but a 1 percentage point loss of growth annually to the violence. And if true, that's substantial, but of course it could be more than that. But as I said, the investment is surprisingly holding up. And you take a city like Monterey, which unfortunately has had some of this problem, but very little. Still getting a fair amount of investment into Monterey. You're not getting much into Juarez for this reason. Now, what has the United States done with respect to Mexico during these hard times? Well, we have done some things. And I guess what we think is the biggest thing we've done is the Merida Initiative. And so there's a nice slide there comparing Merida with the Plan Colombia, and you can kind of read all that, and the goals, which are a little bit different. I would just toss out this thought: if we succeed with Plan Merida in terms of drug cartels operating in Mexico, then the question is, what's going to happen next? Here is an interesting chart of the price of cocaine in the United States. Now, we've had, drug wars have been a staple with us for quite a few years, at least since Nixon. And we ramped it up with the Colombian episode and so forth and so on. You can see, probably hasn't done a whole lot for availability of supply because the price has been falling. And it doesn't seem from collateral statistics, which I'm not presenting here, that the demand for drugs in the United States is dropping, about the same number of addicts and so on. 8% of the population are occasional users, 3% are more serious. So we have pretty steady demand. Supply is maybe flattening out, but certainly not retreating. So then you have to ask, what happens if we succeed with Plan Merida? And where does the supply come from? And then you just picture in your mind the geography of the United States. You have the oceans, a lot of that. We have the Caribbean, a lot of those islands, and then of course you have Canada. But to think that closing down the cartels in Mexico would close down the supply must be some kind of dream. Now, if we kind of do an overview, we come to the interesting conclusion that despite all this violence and so forth, tourism hasn't really fallen very much. And some it's actually picking up. There's continuing flow of FDI. Remittances have dropped, not very much. Oh, they dropped somewhat, not dried up. And then we have, those are the statistics we would suggest watching in 2009. Now, so that's the tourist. You can sort of see the picture there. It's, no big, abandonment of Mexico on the tourism front. No big growth either. FDI flows, we already talked about that. That's into the northern border, though, and there the hit has been, harder than one would have liked, and that probably reflects some of this drug story we were talking about. Now, the response to the crisis, of course, it's not in the Chinese realm. There is a fiscal stimulus. It's modest, maybe 1% of GDP. Mexico needs a lot of congratulations for having hedged their oil. They hedged it to 2009 at $70 a barrel. So that is one reason why the fiscal hit is not so hard on Mexico as it might have been given what's happened to the price of oil. They've done some other things on the micro side. They've frozen gas prices and twiddling with electricity prices and so forth, increasing some unemployment benefits. Now, just turning quickly to Canada, because after all we do have the two neighbors, it's not so different between Canada and Mexico. Now, of course, Canada starts off on the absolute position is quite different, but growth, the contraction is about the same. The fiscal stimulus is more in Mexico, and the budget deficit might be a bit more than Mexico is expecting. So there's a difference, but not a big difference between Canada and Mexico, our two most immediate neighbors. Now, what has the U.S. done? Well, probably Apart from Plan Merida, which gets a lot of attention, we have the 30 billion swap line, which certainly supports confidence, and we have the initiative, and NAFTA, of course, is living, but the trucking, as you know, is still frozen, and that would be one of Mexico's big advantages, to have a straight-through trucking with the United States, and NADBank is still a very small operation, and our stimulus package has some money for border infrastructure, but it's nothing very large. Thank you very much.